Doug McIntyre, the editor-in-chief at 24/7 Wall Street here to talk about the Federal Reserve. Lee Jackson, who's our senior editor for markets, the economy, finance, and covering corporations, is with me. So, Lee, depending on who you talk to, the Fed will cut rates in the summer, the fall, and the winter because inflation is now so low. What's your reaction to that?
Well, given that we've had 2 months already, January and February, where the numbers came in hotter than they expected, I don't think, obviously, clearly the March cut is long been put away, but I think there's an outside chance they don't cut rates in the summer. I mean, although the 4% current rate is a huge improvement over the 11% we saw in the summer of 2022, it has stayed at 4% or right about at this level for 6 months. And unless it can trend lower to Powell's 2% level, they may not cut them in the summer.
Well, here's an argument for you. The economy is doing phenomenally, absolutely phenomenally. If you have even the slightest bit of worry about inflation, even a hint, why do anything with rates? It's like the economy doesn't really need it.
No, and if and if they lower rates, all it's going to do is just keep another match under the already cauldron of the stock market, which is, with the exception of 7 to 10 stocks, has done so. It's gone up a little, but certainly not like the Magnificent Seven have.
So if you're the Fed and you're looking at the things that might happen in, say, the next 90 days, there are some things that could happen that could literally trigger a jump in inflation again. And let me start with oil.
Absolutely.
So let's start with that, oil.
Well, West Texas Intermediate's over $80 again for the first time in 4 or 5 months, and it seems as though that the Middle East issues have been somewhat discounted, like not a really big deal, but with demand starting to come back a little bit in China and here in the United States, if everything tightens up, oil could go to 85 or 90, and that would, of course, spike inflation, sure.
Yeah, because if you look at Americans and what they have to pay for gas, you're probably at $3.50 now. I think once you get to $4 or $4.50, a lot of Americans are either sort of lower middle class, lower class, or just have to drive a great deal, start to feel the pinch. And then if you look at discretionary income and you look at consumer spending as a percentage of GDP, now all of a sudden you've got some GDP risk. And
indeed,
then all of a sudden it gets very complicated. The other thing that seems to me that really could happen over the next few months is, labor is really having the best decade it's had and the best year it's had in 5 decades. I don't think that's over. Do you?
No. And even if it's contained at certain areas like the automakers, because the UAW got their deals, what about everybody else who wants to unionize or to put the pressure on C-suite bosses to say, look, we want more money. And if they got it, we want it. And I think you're exactly right. I think the big labor movement is probably the strongest it's been in 50 years.
Right. And if you said to me, where's that going to go? Where's inflation in the system? I think that you're going to see the big, huge employers. I mean, bigger than the car guys. I mean, the big retailers, the fast food places. At Starbucks, you're already seeing a tremendous amount of agitation for higher wages. The company's management basically just said, okay, we don't want to be taken to the National Labor Relations Board over and over again. We're going to sit down at the table. They're sitting down at the table with 6 figures worth of baristas. I mean, literally, you're probably a couple 100,000 people. If you move over to
Yeah,
Amazon,
for sure.
you've got unions emerging in the Amazon warehouse and driver system.
Hmm.
If you look at what happened to UPS, the raises they gave those people, um, Amazon's labor costs could go up very, very sharply if this union movement continues to take hold.
I think you're exactly right. And of course, that those costs will be passed right along to the consumer because Amazon's not going to eat all that. They're just not going to do it. They'll raise prices.
Moving to two other areas. One is auto loans, the other is mortgages. Um, it's extraordinary to me, but car sales are brisk. Hard to say why that is. Americans are driving a lot of older cars, so it's possible that you're now in the cycle of car replacement. It's
Yeah.
not EVs. It's gas, and it's not like people are saying, "Well, I'm going to trade my gas-powered car in for an EV."
As
That's
we've discussed, that's not happening.
that's not happening. So, is it fair to say that the demand for cars is still high, despite the fact that car loans are 5 or 6% in most cases?
Yeah, I think you're right. And I think you're really on to something. You know, the pandemic probably extended people's ownership length of time for cars. And I think you're right. I think they're hitting that, the point where you get more repair issues and things of that nature. And I think that, some of the car dealers, they're trying to come up with, the kind of not phony rates, but kind of bait and switch rates, which are low at first, but then kind of go higher.
The next thing is housing market mortgages. Mortgages, depending on the week, still 30-year fixed around 7%. People got used to sub 3% just over,
Yeah.
uh, really just over 2 years ago. You're not
Yeah.
seeing a lot of houses moving, but by the same token, it doesn't seem to be hurting the economy.
No, and it's interesting because I think there's a big move for people that were maybe considering sizing down, especially boomer couples with kids out of the house, they're sizing down, and they really can't find what they want because there's not that much out there. So therefore they're not turning over their bigger homes, and home prices have continued to go higher.
And as they go higher, the number of houses that are getting bought and sold has dropped. Now, the one thing this appears to have helped is residential construction. Is that fair to say? When people won't sell existing homes, well, what do? You try to get a deal on a new house.
Well, and the big builders, the D.R. Hortons and people of that ilk, um, typically their homes are of the first and second home buyer. They're not the higher end homes. So yeah, I think that's what they're trying to do. But since most of the major American cities are built far out, they're having to go further out.
They're having to go further out. And as we look at this, it sort of takes the myth that a very active, robust real estate market is very, very important to the economy doing well. Let's close by asking this question. Rates are still pretty high. If they come down, it's not going to be by much, and it may not be soon. What's the engine that's driving the American economy, even though rates are historically, short term history, pretty high?
I think a lot of it is that people are piling debt onto their credit cards. And whether it's for consumer items that they need, staples and food and things like that, or for discretionary items where they're going for things that they probably could do without. I think that's where the biggest problem is going to come in. US credit card debt's over $1 trillion. And as we both know, credit cards tend to charge a little bit more than, say, your local bank.
Sure, 15, 20%, I
Oh,
think,
it's ridiculous what they can charge.
on an Amex right now, I think standard rate's about 22%.
Yeah.
So that's our wrap up of what the Fed is up to. We'll get back together with everybody in June and see what actually happened. But thank everybody for joining us. Take care.
Take care, Doug.